Hello and welcome. My name is Victor Rudistinov, and I'm a real estate analyst here at ABG Sundal Collier. With us today is Kestutis from Eastnine, and I won't stand in your way. I'll just hand over the image and word to you for presentation.
Okay, thank you very much, and thank you for this opportunity to present Eastnine and what are we doing. So for you who do not know, do not follow us on a daily basis, we actually in the process of building a real estate company and doing it in the most exciting part of Europe, actually the fastest growing part of Europe, on the other side of the Baltic Sea and Poland. We are a long-term owner, so we buy and hold our properties. Very strict focus on high quality, very well located properties. And we focus entirely on office today. Currently we are present in Vilnius, Riga and Poznan. We're striving to become a company appreciated by its customers, enjoyed by its employees and valued by its investors. We are headquartered in Stockholm, listed on Nasdaq mid-cap list. When I meet people from traveling in Eastern Europe, actually, they all tell me that there's beautiful old towns and there is a lot of gray areas, great, boring Soviet buildings. But actually, what most people miss is this very, very rapidly growing economy and the new part of the world. And actually, this part is growing very, very fast. Some of those buildings you wouldn't see on Google Maps still, because they've been raised and popped up recently. This is a picture of Warsaw skyline. But this is very similar in Vilnius and in many other places where we are actually acting. So why we think it's such an exciting place? You can actually see on this graph, since 1998 to 2023, actually Poland, Lithuania, Latvia, the markets we're in, are among the fastest growing in Europe. And actually the expectation that they will continue growing in GDP faster than others. Of course, Ireland and Malta are a bit faster, but they're very, very tiny markets in general. So Poland being one of those really big, exciting countries as well for our future. Another very important aspect that people miss is actually we are in a very different structural environment. There is a pending demand for office work, and it's actually growing. This is a picture from Vilnius showing that the number of office jobs between 2000 and 2022 actually has grown significantly, but stands still for 19% of the overall employment in the cities. But if you look on the more developed parts of Europe, slower growing, it's around 26, 29, 30%. So we are still in the market that is not saturated and has the structural growth potential going forward. There's also a combination of higher yields and lower rental levels that makes it so exciting. And these curves, they diverge if you compare to the more developed market, but at some point of time they will converge. So either the rents will increase and the yields will probably start falling in the future once the markets become more saturated, but it will probably go to sort of in both ways. And this is a very exciting combination to be early on in this market and actually start investing in it. We still are 1/5 of Stockholm rents. Of course, Stockholm is an outlier, but at least half of the sort of more developed markets where we look anyways, and actually in almost twice as high yield levels in general. This in combination with the same financing conditions. So the margins that we sort of can make are significantly higher in this part of the world. And this is just a graph showing how our journey to date. We have been growing our real estate portfolio very fast, as well as revenue streams. And now we are in 3 cities. So what we do and what we focus actually is that We focus on very modern buildings of high quality, relatively flexible office space. In general, we have approximately 10 square meters per employee. So this is, again, compared to Stockholm, which is higher. This is already relatively efficient use of office in our premises. There's still potential for downsizing for some companies, but actually we've been benefiting from this trend overall. Intelligent and sustainable buildings, inspiring ground floors, and service speaks beyond expectations. Also, we look at the services where we can actually be also accessible from all the communication point of view, but also in the vibrant places. And we also spend a lot of time to understand our tenants and their needs and actually how we can work and having a bit of a hospitality attitude, which is also a bit unique because most of our competition is owned by the funds. In Poland, almost 95% of all properties are commercially owned by different fund investors, and they never have even any relationship with the tenants, which is an opportunity for us, as I see it. So if you look on our operations, overall property value, almost 600 million euros. We still own only 14 properties, but they are relatively big in size on average. 182,000 square meters of office space. Occupancy is almost 93%, and average age of our portfolio is 10 years. Many properties are actually younger than that. We have a couple, one or two that are 20 years old that bring down the average a little bit. We are in 3 cities, Riga, Vilnius, and Poznan, but they all are along this railway line, the infrastructure line that will connect the Baltic states, Poland, with Western Europe with a fast-moving train, which also will integrate even further the whole region. And we believe that this integration, again, will be very creative in terms of jobs, trade, and GDP growth. We also are located in very central parts of each city. So in Vilnius, we actually have 3 clusters, and starting with another cluster just in Naujamies is a new part, which is more tech companies would like to stay and be. In Riga, we are very centrally located along Main Street, and in Poznan we have only 1 big property, but it's very big. It's almost 40,000 square meters, and it's in the very, very heart between the railway station and the city center and the old town. So this is just a glimpse of our properties. I will not go into detail. Just note that you see the environmental certifications. They are very, very high in the top brackets of every possible evaluation scale, which is kind of LEED and BREEAM that are the main 2 international that are used. So overall, portfolio has been growing very nicely, but also the rents have been growing in our portfolio. And this is a little bit showing actually the potential. Once you have a very high quality portfolio, we're actually managing to increase the rents even though we see higher vacancies in the market overall. But we see companies downsizing, but companies are ready to pay additional euro per square meter, but to get a better location and better premises. Our vault, it will be fluctuating around 4 years. Occupancy 92.7, and surplus ratio, which is very high for office at 92%. And we believe that will stay because of the structure of the rental agreements in the market. So this should be above 90%. We aim at least keeping it above 90%. The key tenants, we still have high concentration to certain of our tenants. This is partially one of the risks that we have. but at the same time, they are all exposed to a very rapidly growing part of the economy. And this is a result of a build-up phase in our portfolio. So once we add 2 or 3 more bigger properties, actually this will change significantly. And of course, we try to reduce a single tenant exposure risk, but at the same time, these are very, very strong names. Allegro is the leading Polish e-com player. It's actually 6th largest globally, and a very profitable operation. Danske Bank, you all know. Telia, you all know. Vinted is a Lithuanian unicorn. I think they are present in Sweden as well, selling secondary clothes, second-hand clothes. Swedbank, Rockwool, Citco, you probably know all of the other names. So in terms of sustainability, 100% of our portfolio is now sustainability certified, again, in the highest brackets of each system. Green financing stands for 69% of our overall financing. We only have bank debt in our financing. Green leases, 68%. We have an ambition to be leader in sustainability in our market. We target our operations to be climate neutral by 2030. This is the property operations. In Lithuania, we're almost there. We're not there in Poland. We target 5 stars in GRESB. We lost 1 star last year, but this is just due to historic comparative reasons. We are happy because people came back more to the office and consumed more water and so on, but this affected us negatively in terms of environmental impact, unfortunately. Yes? It's similar to Swedish gröna lån-leaseavtal. So it means basically we add on a commitment with the tenants that we do environmentally. We try to save energy. We attempt to sort the garbage and so on and so on. So this is a type of addition, add-on to the lease agreements. So in terms of financials, relatively still quarter on the top line, growing only 1%. But on the bottom line, we're actually doing extremely well, up 17% in profit from property management. If we compare to Q1 last year, if we compare to basically even Q4, we're also growing even faster. So overall, strong underlying performance. If we look at our financial position as such, we have very strong, very big cash position, 128 million euros, and the overall balance sheet of 700 million euros. In terms of earnings capacity, there is a slight decrease compared to the year end. This is mainly affected by some of the one-off effects that will, of course, stay in our books for the next coming 12 months. But if you compare to basically rolling figures, so we still have growth potential, and we will continue to grow over this year, even without adding additional properties in terms of our profitability. We have very strong financial position. So if you look on cash, 128 million euros, ICR 2.7, increasing even with increased interest rate level overall in our portfolio. And our portfolio, I mean, we have shorter maturities overall in the market because we are only bank finance. So on average, our maturity is around 2.5 years when you roll it. So this is something that affected us, of course, negatively in this higher interest rate environment, but still we are in a very sound position. LTV at 27%, net debt to EBITDA at 5.2, which is probably the lowest in the market today, and maturities are starting to increase as we gradually refinance our loans. Yes. There are certain, we had the refinancing in Q1.
What do you expect the rate to be for the coming quarters?
I think it's topping here somewhere, yeah. So overall, just briefly to recap our case, we are a growing company with a unique portfolio of very nice modern office buildings, growing in the very fast-growing market, the fastest-growing market, the fastest-growing part of Europe. We have sustainability certified portfolio, so it's very sustainable. It's also sustainable from the customer perspective. We believe we have very strong tenant relationships with very strong names. And of course, it's an exciting journey to be in. So I think I've done almost in time.
Yeah, it's just on time.
Yeah.
Thank you very much. I'll get back on the cross. So you mentioned you whisked by it here, the balance sheet. But this is the key issue to understanding Eastnine now, isn't it? You didn't mention this in the report, but in Q3 of last year, you sold Melon Fashion Group, which was a Russian fashion retailer, and received the cash from that. Do you just want to mention that quickly before we go into the other questions about that divestment?
Well, I mean, this investment was a part of our historic portfolio before Eastnine history, so to speak, started in 2000, or restarted back in 2015. We were an investment company holding a wide portfolio of different assets, and this was one of the historic assets that developed extremely well. It was a Russian fashion retailer, something similar to H&M or Inditex. But locally Russian, where we held around 36% of the shares in the company. And of course, this company was growing extremely well. It was totally debt-free, developing very well. And then we planned an IPO. It just didn't happen because of the war broke out. And then it took me 2 years to complete the exit, which finally was very successful. We managed to exit that holding and receive the proceeds, even though it was kind of complicated process to do it in the midst of the war, and of course with all the sanctions and all the limitations that are imposed on both foreign investors and money transfers and everything. But the money is in Sweden and safe.
Yes, and then
with Swedish safe banks. So.
Yeah. But that was very impressive that you managed to actually get the funds. And so you've used some of that funds to buy back bonds.
We bought back the bond because this was our most expensive financing source.
Right.
And that was maturing very early. So we thought that this was a good way to actually to utilize part of that cash.
Right. Maybe we could go back to the balance sheet slide
Sure.
just for the audience as well, because that means that you now have a cash position of some 128 million euros. That should be put in perspective to your property assets, around 600. You're a property-owning company. You've identified Poland as an attractive market. How much of that capital are you looking to employ in Poland in the near term, and to what sort of yields?
In general, I think we will employ that cash, and we're working on a number of acquisitions right now. We'll probably employ a majority of that cash, and I think our kind of acquisition capacity, let's say, is around 200 million euros today, given a 50% leverage level. The yields have increased. I think in general what we are looking is, if you look for the regional Poland, probably is right above 7%. And if you look in Warsaw, is just above 6%, but that is for very modern, newly built assets. I think what is more important to look is probably the capital values, because we are buying right at the level or very close to the construction cost today. So from the risk perspective, there's not such a big discrepancy, to be honest, which protects a bit of a downside risk, because construction costs have been growing over the years, of course, driven by inflation, driven by a number of factors, including the war. But what we see today is that The prices for land have not been affected negatively. On the contrary, the residential market is actually booming in our part of the world. It's partially pushed, of course, by a very high refugee movement from the war in Ukraine. But also in general, we see very, very strong underlying growth in the economies and relatively poor living standard compared to at least what we have here. So there is an upgrade need overall, and the residential prices have been booming. And residential actually prices now have become significantly higher, so it's more profitable to build residential than commercial. And that we believe that it will be sort of, this will compete for the land banks. At least we see a lot of commercial projects now being transformed into resi. Resi for rent or resi to buy. And this would also probably will keep the levels, construction levels or pricing higher.
So why have you chosen, because you've selected, there are a number of Polish cities that you could invest in, but you seem to have narrowed in on Warsaw and Poznan.
Yes.
Why is that?
Because of the specifics of each particular market. Of course, Warsaw is a capital city. We haven't done anything yet in Warsaw, but we're looking into Warsaw. And Warsaw take a longer time for us to understand and to evaluate and actually understand dynamics. So that's why we'll be a bit more cautious about Warsaw, even though it's probably easier to do deals there. At the same time, we understood Poznan very well, and we spent a lot of time actually analyzing overall market, seeing sort of where how the market evolved, and we decided not to go for Krakow and Wrocław and those kind of very popular secondary cities, but we chose Poznan because we understood. We found a very nice micro location. It was easy to understand the city for us, and at the same time, there was a prime opportunity to be in. It's also there is an opportunity to build a very strong position in the market. So when we enter a market, we want to reach 10% market share relatively quickly, so that we become an important player. And today in Poznan, we are already at 5-7% of the market, of the overall market, and probably if you look on the prime segment, we definitely bigger share there. Same in Vilnius, we are 10% market share, but around 20-30% in the premium segment, depending on how you classify various properties. So when you are in this segment, you want to be in a significant position, so you are actually in the play all the time.
And just a final question then, before we're out of time. Who are the big, because you focus on newly produced or new properties, right? Who are the big developers in Poznan and Warsaw that you'd be looking to perhaps buy from?
I mean, there are three big players in Poland. It's, of course, the Swedish Skanska is a big player, and we did one transaction with Skanska. There is another called Jelamco, and there is Echo Invest, which also has, which is a American-owned, but has a former Skanska CEO, so a Swedish-speaking CEO. So a lot of Swedes there already. So
that's interesting.
Yeah.
Okay, I think we're just about out of time. I'll thank you, Kęstutis, for the presentation. Thank you.
Thank you.